What a terrific start to the day. Heavens, we're talking like 8-1 advancing to declining stocks. Strong right across the board. Just take a look, and you love it, of course, when the cyclicals lead, and you particularly love it when we get some action in banks, finally. Bank stocks leading. Semis been leaders all month. Consumer discretionary doing well. Retailers are doing very well today. Energy's a standout performer. Energy's probably up 3% on the month. That's outperforming. Nice to see utilities lag. That's probably the best performing group for the month of March, along with real estate investment trusts. So the stock market, you all know, gets fixed on things. Once in a while, it gets fixed on oil. Now it's fixed on the direction of interest rates. So take a look at the markets today and what matters here. What matters is global growth and bond yields. That's what matters right now. And the divide line, the debate is, what side of the recession debate are you on? Are you on the side that recession fears are real and we're going to have a recession in 2020? Are you on the side that recession fears are overblown and we could avoid it? That will determine your outlook for everything at this point. Now, one thing that would really help the bull argument is, of course, the street is obsessed with that 3-month, 10-year Treasury spread, which has been negative. That is, when you subtract the 10-year from the 3-month, it's been negative. And here you see that. That's what's everybody worked up about. Right now, it's about 2 basis points. So you're dealing with 2.45 for the 3-month and maybe 2.43 for the 10-year yield. And that's about a 2 basis point spread, as you can see there. If that were to go positive, you'd have a lot of relief on the street. Why? Because the street's obsessed with this right now. And eventually it will not be obsessed with it. For the moment, it is. And remember, I don't normally do yields, but Pisani's law, when stock traders start talking about something besides the stock market, pay attention, because it means they're worried about it. So I've been doing this a long time. I pay attention when the street's worried. To show you how fixed the market is on this, look at what happened yesterday on the rates. I put this up at the close. 2-year, as the market moved, as the yields on the 2-year moved down, that's the white line, later in the day, the market moved down. And things started recovering when the yields started moving back to the upside. And that shows you how fixed the market is on rates and the direction of rates. Speaking of rates, speaking of technicals, market has been holding up pretty well. There is the old 50 versus 200-day. That purple line is the 50-day moving average for the S&P this year. That solid line across there is the 200-day. We'll get what's called a golden cross here very soon here, where the 50-day crosses the 200-day. So that's 27.42 for the 50-day, 27.55 for the 200-day. That hasn't happened in a long time. That's generally considered positive. And yes, this stuff does matter. Technicals matter in this kind of environment. So we'll keep an eye on all of that. And we're just waiting for a significant breakout. We hit 28.54 on the S&P 500 last Thursday. That was a pretty significant breakout overall. We're still having trouble getting above that, though. If you want to know where we are, waiting for new highs, it's like watching paint dry, because for 3 weeks now, it's essentially been consumer names, your Hershey's, your General Mills. General Mills had a great report last week, Mondelez, and then you're looking at utilities like Exelon, and you're looking at other groups that are out there that are sitting around like real estate investment trusts. Hasn't been a lot. So we've got breakout on the S&P, but not a breakout on the new high list. Not significant, for example, tech stocks breaking out to new highs or anything like that. Then you'll see a lot more squawking from the technicians. We're sitting right near the highs for the day.